So a portfolio loan, essentially a bank holds it in-house, and so they can set their own criteria. So all the like underwriting and all the hoops they make you jump through for conventional loans, like they can do whatever they want because it's just theirs. Like they essentially sit down as like the owners of the bank and like the managers of the bank and say, do we want to loan to this person? And so they don't need to adhere to anyone's rules because they're not then later going to sell this mortgage on like the secondary market to like make money off of. They just keep it. And so they can do anything. They can package multiple properties in one. You can do single portfolio loans on each house. They can choose to, so the Stealthy Rich found a bank that will loan up to 20% loan to value on the appraised price. So not the purchase price. And that's how they have grown so much. I hunted and hunted for this unicorn, at least like with the time I have, because we're like really.
Did you
like,
find it?
We both have full-time jobs. No, I haven't found one yet, but I want to keep looking. So I didn't have the bandwidth to keep looking, but it's worth hunting for, and I still intend to keep looking. But apparently it used to be really real. Apparently pre-2008, that's what everyone did, but houses were appraising for a hell of a lot higher than what they were probably worth then. And so banks are like really afraid of it. But some local private banks, if they believe in your like plan and you're a good customer, they will do it.
Really?
And so our bank said if we build up history with them, they'll get more flexible with what they'll do with us if we are like consistently good payers on our portfolio loan that we have with them. So I don't know what that means yet.
Interesting.
So it feels shady, but it's like, you know, the bank just has to approve. And if they believe you're a good person and they can trust you, then you can do that. This is the important thing I just learned about portfolio loans. So I was getting pre-approved to buy my next property, and I was just going to do a conventional 20-year loan. And I was calling around for like local banks, and I got my pre-approval letter. And when I was filling out like the online applications to get your pre-approval letters, I put in the rental properties that we had, but the other lenders can't see my portfolio loans because they're not like findable. So like my debt to income ratio looked like nothing because they're all in a package together that's not sold on the secondary market. It's just held within farmers at this like bank we use. And so like the other lender could only see my primary residence. They couldn't see any of the other loans I had.
On your DTI.
Yeah.
Yeah, I've actually had kind of the same thing. Because I have partnerships, banks don't see the properties that I'm in partnership with.
Yeah.
They're just like, they pull my credit and they're like, oh, you have 3 loans and you have like 8 cash flowing. They're like, oh, that's really good. And I'm like,
you're welcome.
No, sorry,
I don't know if you can do a portfolio on owner occupied. I'm assuming someone would, but I know that our portfolios were all on the commercial side though.
So talk to us a little bit about like how you run numbers, how you do all that with your Excel sheets, how you keep it tight, how you like give us the what's your Instagram again, the nerdy part of your IG.
Yeah. So I'm a big spreadsheet person. I actually just like put my spreadsheet on my blog if you want to go like check it out. I think I put some screenshots on there, but anyway, so I'm a big like 1% rule believer, which I know like I don't know if anyone disagrees with the 1% rule, but right now we aim for like 1.3 to 1.4% on our properties. So we want to do better than that. And the main reason that is because essentially the 1% rule is saying like, this is how it kind of made sense in my head, because essentially the 1% rule is there to say, do I shove the money that I worked really hard for into real estate, or do I put it in the stock market? And I'm sitting in a group of like real estate people, but stock market is so passive. Like I just set up my like IRAs or my brokerage account and I put it in index funds and I don't do anything with it. And you can like earn lots of money that way. But essentially the 1% rule says, okay, so if I put it into real estate, so for the whole year, I should get 12%. 1% every month, 12% a year. And then after, you know, inflation and all of the other stuff, your return is going to be about the same, maybe a little bit better than the stock market. And so that's why you favor real estate if it's the 1% rule is better, because your returns over the long run will do better than your index funds would that I invest in as well, or ETFs. You can do either one. I do all the standard things like the bigger pockets sheets do. Essentially, I didn't want to pay bigger pockets. for their spreadsheet. So I like made my own. So I run like cap rate. I do account for like vacancy, maintenance. I always run my numbers with management costs, even though we self-manage. And then that's a Bigger Pockets quote from someone. I wrote it down. But anyway, they said, if you don't run your numbers with management costs, you're buying yourself a job, which I thought was really smart, because if I ever want to exit this and I say, wow, this management is too much work, I want to hire someone, I always build it like I, could pay someone to do it and my numbers would still work.